Hey folks, what we're now going to do is just remind you of some of the fundamental rules of the foreign tax credit for a corporation. Obviously, this has been in the news quite a bit lately, so I suspect that they may have busted up a couple of extra questions just to make sure candidates are aware of these issues. So let's go through some of the fundamental rules so that you're prepared for any question they ask on the next exam. When it comes to the foreign tax credit review, let's remind ourselves, the United States taxes a U.S. corporation on its worldwide income, not just the income earned in the United States. The goal of the foreign tax credit is to keep a U.S. taxpayer's worldwide tax rate from exceeding its U.S. statutory rate. That's because we're going to give you a credit, your corporation a credit, for the taxes they paid in another country back here in the United States. This is accomplished through the foreign tax credit limitations. Step one of the foreign tax credit calculation is determine the qualified foreign income taxes paid or accrued for the tax year. To be creditable, the foreign levy must be a tax, the predominant nature of which is an income tax in the U.S. sense. In other words, taxes on wages, interest, dividends, royalties would generally qualify. The foreign tax credit has a limitation. This is done, by the way, by multiplying the amount of pre-credit U.S. tax paid in a year by the ratio of, and you'll notice the numerator here is the foreign income sourced taxable income earned. Note the foreign income sourced taxable income earned, and that would be divided by the worldwide income. So pre-tax credit is the U.S. tax paid times that ratio. So hypothetically, if the foreign tax sourced income was $1 million and worldwide income was $10 million, well then 1/10 of your U.S. taxes paid, 1 million divided by 10 million, 1/10 of the pre-credit U.S. tax paid could possibly be eliminated. Step three of the credit, the foreign tax credit. It's the lesser of the qualified foreign taxes paid or the foreign tax credit limitation you just had. So here's another example. Simple Foreign Corp has $300,000 of U.S. sourced taxable income and $200,000 of foreign sourced taxable income from country X. Simple Foreign pays $80,000 in income taxes to country X. All right, that's the credible taxes. The U.S. tax before credits on the worldwide income is $170,000. So can we get a credit for that full $80,000? Well, we'll have to see. So what we do is we say we have $170,000 of potential U.S. tax. We take the $200,000 of foreign sourced income over the total worldwide, which is both the $200,000 of foreign source plus the $300,000 of U.S. 200 plus 300 equals the 500. So 40% maximum of the U.S. tax can be forgiven. 40%, 2/5, 40% of the U.S. tax of 170 might be forgiven. That's 68,000. So we now compare the 68,000 to the foreign taxes paid. And if you recall, the foreign taxes paid in this particular case, when we did that calculation, we found that the total amount paid was 80. So it's the lesser of the two. So it's 80 or the 68. And of course, the 68 is the lesser of the two. So we are allowed to subtract $68,000 of our U.S. tax. So instead of paying 170, we'll pay 102 in tax in the U.S. That's how the computation is done. Hopefully this helped. And now you're ready to work another exercise.